What if only 10 companies could shape most of your returns? In the year 2026, what if these businesses are not just growing, but compounding machines that are nearly impossible to replace? And if you miss them now at the very start of the year, do you risk falling behind for the entire coming cycle? This is not a typical stock list. These are firms with wide margins, deep economic moats, and durable business models. In many cases, they face almost no real competition. If you grasp the logic early, you may rethink your whole year. As the year 2026 begins, focus turns toward 10 companies, positioned strongest in the market. These are not momentum stories. They are enterprises able to reinvest at high rates for long periods. They generate steady compounding effects year after year, often without dramatic headlines. They quietly pull major indices higher, becoming silent engines of progress. The analysis goes beyond price action. It centers on core investment theses, updated context, and long-term rationale. Conviction is not expressed in words alone. When a thesis proves compelling, capital follows with real commitment. A strong daily portfolio gain may look temporary on the surface, but it reflects underlying business strength. High-quality companies, given enough time, do most of the heavy lifting. Investors often ask, why did a stock rise today? In truth, you control what you buy and how long you hold. You do not control. When markets reprice assets, what you can control is the quality you own. When earnings grow steadily, when free cash flow per share expands, valuations eventually adjust upward. Catalysts may appear suddenly, sentiment may shift quickly, but fundamentals drive lasting results. The first company discussed is ASML. Recent price strength is not random movement. It has been monitored closely, especially when sentiment was cautious. Even after significant appreciation, the long-term thesis remains intact. The core reason is simple. A near absolute monopoly position. There is no true second place, nor even a credible third. Most so-called monopolies are really duopolies or oligopolies. ASML stands apart. In a category of its own, recent momentum reflects multiple reinforcing factors. Analysts revise their outlook, raising expectations for profits. In the coming years, production capacity is expanding. Demand for advanced lithography systems remains structurally strong. Extreme ultraviolet systems and deep ultraviolet systems are essential to chip makers. Memory producers and international clients continue to depend on these machines. Pricing power within the EUV segment appears sustainable over time. Beyond traditional analysis, public awareness has also increased. A detailed technical documentary explored the engineering complexity behind the most critical machine. Millions viewed the explanation of why replication is nearly impossible. Even heavily funded initiatives have failed to duplicate this ecosystem. Decades of accumulated expertise form a barrier few can cross. All these elements together create a coherent long-term thesis, businesses that cannot be replaced. With high reinvestment capacity and durable demand tend to anchor market performance. Identifying them early, holding them patiently, and ignoring short-term noise reflects the disciplined philosophy long advocated by great investors. When you truly understand what they have built over decades, hundreds of millions of dollars, for each machine no longer shocks, but becomes reasonable in context. The value is not the machine itself, but the irreplaceable position that it represents in the system. As more investors and analysts, and even large institutions, recognize the depth of that edge, a shift in sentiment becomes inevitable. Valuation may still spark debate, but focusing only on short-term numbers, while ignoring structural dominance and essential industry role, is simply too narrow a view. In the investment logic, that Warren Buffett emphasizes when you find a business with no real competitors standing at the center of a long-term growth trend. Owning it is not speculation, but a strategic decision. ASML is a direct gateway to the global semiconductor boom with almost no traditional competitive risk involved. Technical barriers, supply chains, accumulated knowledge, and deep customer trust form a fortress that few companies in history have ever been able to build. The next name reflects a different kind of opportunity, more subtle and more nuanced. Amazon may have lagged behind other leading technology firms recently, yet that very silence creates space for patient investors. While others were celebrated for spectacular performance, Amazon quietly restructured and upgraded its ecosystem. It is a rare multi-sector giant, from electronic commerce to cloud computing to digital advertising, yet the market still seems to undervalue its full potential. A key part of the thesis centers on its artificial intelligence powered shopping assistant. Hundreds of millions of customers have interacted with this tool, and the impact goes far beyond user experience alone. When a system significantly raises the probability of completing a purchase that represents direct and measurable return on investment from artificial intelligence, and this is only the beginning before advanced automation features are fully deployed at scale, agent-driven commerce, where systems predict and optimize buying behavior in advance, opens substantial room for growth in gross merchandise value and operating income in the coming years. Even more notable is the spillover into advertising. When purchase intent becomes more precise, the value of advertising space rises accordingly. Contrary to fears that artificial intelligence would level the playing field, it may in fact strengthen the position of platforms with superior data, infrastructure, and scale. Very few companies worldwide possess logistics networks, cloud computing power, and data reserves large enough to deploy artificial intelligence on a global scale. Amazon is one of those few, alongside technology growth stories. There are traditional financial fortresses, no less resilient, such as S&P Global and Moody's. These institutions are embedded deep within the structure of the global debt markets. Whenever a company issues bonds, a credit rating is almost mandatory. Refusing a rating does not reduce cost, but often increases the cost of capital as investors demand higher interest compensation. For unrated debt, that mechanism creates durable power for rating agencies. These firms operate with asset-light models, high profit margins, and deep integration into the global financial system. Disrupting their position is nearly unimaginable because the credibility and standards they represent have become part of market infrastructure itself. And this is the common thread running through the entire list. Companies with strong pricing power, the ability to compound value over many decades, quietly building wealth for shareholders over time. As we move deeper into the year 2026, these are the businesses that form the solid foundation for a disciplined and pragmatic long-term investment strategy. That is why exchange-traded funds, large institutions, and banks rarely purchase unrated debt. When a bond lacks an official credit rating, its interest cost rises sharply, and over time the issuer pays a far heavier price. This is the foundation that makes S&P Global and Moody's natural monopolies. They do not force their services on the market. The structure of the market compels companies to seek them. This model is very different from closed technology ecosystems. where users are locked in and fees are imposed. Here the order is reversed. Companies approach the rating agencies, willing to disclose information to meet senior leadership just to secure a favorable credit opinion. They do so because a strong rating can save millions or even billions in borrowing costs over the life of the debt. S&P Global and Moody's stand at the top of the financial value chain. With S&P Global, there's an additional motive beyond lowering borrowing costs. Many firms aspire to be included in the S&P 500, the most prestigious equity index in the world. That dual role alone places S&P Global in a higher tier than most corporations. From a long-term perspective, these are rare investments whose mechanics become clear once the core drivers are truly understood. History shows they operate as reliable compounders, benefiting directly from the steady expansion of global debt markets. A strong move in a single session is not the true reason to own them or avoid them. What matters more is what is forming structurally ahead. A recent catalyst came from an upgrade when Moody's was moved from hold to buy. The reasoning behind it is simple yet powerful. For years of high interest rates, many companies delayed refinancing, creating a large buildup of postponed debt issuance. When financial conditions ease, a new wave of issuance becomes almost unavoidable. Some describe this as a wall of debt because firms have no real alternative but to refinance. Each new issuance must pass through the checkpoint of the rating agencies. An easy image is a bridge with a toll booth in the middle. During high rates, traffic builds up at one end of the bridge. When rates decline, cars begin to move. And each one must pay the toll. That is the essence of the business model. Owning these companies is therefore not about short-term price action, but about the structural necessity of the system over many years ahead. Macro factors can also reinforce this thesis. When a nation restructures and returns to international capital markets, government bond issuance is almost certain to follow. Any credible sovereign issuance requires a credit rating. That means additional revenue for the rating agencies whenever global capital flows expand. At a deeper level, debt itself is a long-term trend of the modern economy. Governments, corporations, and financial institutions rely on leverage to support growth. As total global issuance continues to rise, the role of rating firms becomes more essential and more irreplaceable. Over time, from credit monopolies, we move to another fortress within the payment system. Visa and MasterCard. These are companies every compounding investor should study carefully. Although widely recognized, their true economic power is often underestimated. Visa and MasterCard control a large share of global digital payments through complex multi-sided networks. The value of the network grows exponentially. Each new cardholder makes the system more attractive to merchants, and each new merchant makes it more valuable to cardholders. This reinforcing loop creates barriers that are nearly impossible for new entrants to overcome. Today, their scale reaches billions of cards in circulation worldwide, and the numbers continue to grow naturally. Year after year, attempts to bypass them are often overstated because even alternative methods frequently rely indirectly on their infrastructure. Consumers demand convenience, and trust Merchants require broad acceptance. Those two pillars are exactly what Visa and MasterCard have built over many decades. Their strategic difference is also important. Visa concentrates primarily on maximizing network scale, seeking presence in every possible transaction. Additional services exist, but they are not the main focus. MasterCard chose a more diversified path, investing heavily in fraud prevention, identity authentication, and data analytics. It positions itself at the trust layer beneath all payment forms, whether cards, real-time transfers, or digital assets. Trust is the core product that MasterCard monetizes in a world where every transaction must be verified, and protected that foundational role offers durable growth potential. Both companies are exceptional, and the choice depends on individual philosophy. Finally, among powerful firms that have reinvented themselves, GE Aerospace stands as a clear example. Once known as a sprawling conglomerate with many consumer divisions, it divested non-core assets and became focused purely on aerospace. As the structure streamlined and investors recognized the true nature of the business, the stock performance reflected that transformation. This illustrates that when a company controls critical technology in a high barrier industry, long-term value is eventually recognized by the market. Many people look at GE and quickly conclude that the story is simply an aviation recovery cycle. That view is too shallow and misses the core point. GE Aerospace is not a cyclical travel business. It is more like a claim on global gross domestic product growth disguised as an industrial manufacturer. The company builds some of the most complex jet engines on Earth with technical depth so advanced that for more than 50 years, no meaningful new competitor has entered the field. These engines are not ordinary commercial products. They are regulated, certified, and tightly controlled by aviation authorities and governments. Once a GE engine is installed on an aircraft, it generates aftermarket revenue for decades to come. Airlines are required to purchase replacement parts and services directly from GE because safety standards and regulations do not allow unauthorized third parties. And that means GE effectively controls the replacement parts market for everything it sells. This is the structure disciplined investors seek: extremely high barriers, long-term recurring revenue, and pricing power protected by regulation and the laws of physics. Each new engine delivered does not only create initial sales revenue, it also expands the global installed base. As the number of engines in operation increases, future service revenue rises accordingly. This is similar to a SML selling advanced lithography machines, then retaining long-term service control. GE sells engines and then owns the service stream throughout the product life. The strength of this model lies in predictability and durability. It cannot be easily disrupted by software innovation, new startups, or sudden competitors. Its competitive edge is defined by physics, engineering expertise, and global regulation. In addition, current management has streamlined the structure focused on execution and profitability and aligned clearly with shareholder interests. This is the type of business that compounds quietly while the market chases louder narratives. For that reason, GE Aerospace deserves recognition as one of the most resilient enterprises in the world. When placed beside companies like ASML, clear structural similarities in competitive advantage begin to appear. With those characteristics, GE Aerospace is a serious candidate for consideration in the year 2026, especially for investors seeking long-term stability over short-term volatility. After reviewing 7 companies, the final 3 names stand out even more for their essential role in the global economy through deeper study of the semiconductor industry and its supply chain. One company emerges as increasingly vital, and that company is TSMC. At first glance, many consider it obvious, an excellent chip manufacturer, yet still cyclical. That perception was common for years, viewing TSMC as a high-quality but boom and bust hardware producer. Today, that thesis appears outdated. TSMC has evolved beyond a traditional cyclical model, yet the market sometimes still prices it as if it were just another semiconductor foundry. In reality, TSMC has become a global utility for advanced computing. Every smartphone, every personal computer, every data center, every artificial intelligence model, every smart vehicle, and every advanced device with a chip inside depends on fabrication through TSMC over more than a decade. The company has built structural advantages based on manufacturing expertise, massive scale, and physical constraints that competitors cannot easily replicate. This is what I describe as a physical monopoly. If network effects explain the strength of digital platforms and market structure explains rating agencies, then physical monopoly arises from the limits of science and engineering reality. ASML has this quality. GE Aerospace has it, and TSMC possesses it as well. In the case of TSMC, the barrier is not only capital or patents, but accumulated experience at the nanometer scale, a refined supply chain, and operational capability at a scale. The world depends upon when a company reaches a position where the entire global technology industry must pass through it to function and advance. It is no longer a simple cyclical stock. It becomes an indispensable link in the infrastructure of the modern economy. As I observe the global technology shift, I see computing demand is no longer cyclical. It has become structural and deeply embedded in every layer of the modern economy. The world does not simply want computing power. At times it requires constant uninterrupted processing. As chips grow smaller and more advanced, manufacturing complexity rises exponentially. Barriers to entry become nearly impossible for new competitors to overcome. Although TSMC has rivals like Intel and Samsung, in the most advanced technology segment, competition remains largely theoretical. Very few companies can match its scale, productivity, and precision in leading-edge manufacturing processes. This means in advanced chip production, TSMC holds a practical monopoly, and monopolies naturally gain pricing power. In the premium segment, there is little pressure to cut prices because no equivalent alternative exists. That central role explains its deep impact on global GDP. A system-level company like this rarely deserves a low valuation multiple, yet the market remains cautious. The primary reason is geopolitical risk, specifically concerns about conflict involving Taiwan. This factor causes investors to heavily discount the valuation. Even Warren Buffett once referenced geopolitical concerns in his remarks. When Berkshire Hathaway reduced its position, the risk is real and cannot be ignored. Any prudent investor must consider it. However, when weighing probability and consequence, the market may be overestimating the danger. First, TSMC is diversifying geographically. It is expanding production into the United States and beyond. Second, Taiwan holds strategic importance for both America and Europe. Any military escalation would carry severe economic and political consequences. China understands the potential cost. Therefore, while risk exists, current discounts may reflect emotion. More than balanced analysis at around $325 per share. The company appears significantly undervalued relative to its dominance and importance. Over the long term, near $500 per share seems more reasonable if structural advantages persist. Looking further into the semiconductor chain, Synopsys stands out. Though less familiar to the public, among thousands of companies, only a few are mission critical. Without them, the entire system could stall. Synopsys is one of those companies. At a basic level, firms like Apple, NVIDIA, AMD, and Google design chip architectures. But before those designs reach fabrication, they must become physically manufacturable. That complex transition is enabled by Synopsys software. The company provides essential tools for design simulation verification and production preparation. The complexity of this software is almost unimaginable. Over the past decade, Synopsys expanded through acquisitions. Its platform now functions like an operating system. For chip design, its tools are deeply embedded. In client workflows, replacement would be extremely costly. Here, complexity becomes protection. Just as ASML machinery is too complex to replicate and search engines are too advanced, to easily challenge, Synopsys platforms demand vast resources in cost, time, and expertise. Most potential rivals do not even attempt entry. Beyond software sales, Synopsys owns extensive intellectual property. Its digital designs become licensed assets, generating recurring revenue for years. As chips approach atomic scale, limits complexity grows exponentially. Further strengthening Synopsys' position, this is a business one can hold for 10 years or even longer, ignoring short-term volatility in exchange for durable growth. Finally, there is Netflix, a company I continue to value. As we move into 2026, the stock has declined from prior peaks, yet the core thesis remains intact. Netflix now serves over 300 million subscribers. That scale creates powerful per unit economic advantages. When Netflix spends $1 billion en content, that cost spreads across its vast subscriber base. Per subscriber expense becomes far lower than smaller streaming competitors. If a smaller platform spends $1 billion, the burden per user is dramatically higher. This difference creates a meaningful competitive edge. Netflix can invest more aggressively, deliver stronger value, and still maintain profitability. While many firms struggle, as they scale, Netflix benefits from size. The larger it becomes, the stronger its economics grow. Content cost per user declines. Value delivered improves. Competing services appear increasingly expensive by comparison. That is why I continue holding and have added shares in recent months. When viewing these companies together, a common pattern appears. Extreme operating models, clear pricing power, structural advantages, and long-term compounding. These are not ordinary businesses. They are foundational enterprises within the global ecosystem. Listening to and reflecting on such financial perspectives helps investors understand the economic landscape this year and encourages disciplined long-term thinking amid short-term market fluctuations.